Thank you, Neil, for the opportunity to be here. It's really a great honor and a privilege, and to have some of the thoughts I'm going to put forward to be discussed by such distinguished people was also a great honor. It is a particular honor to speak after Randy Krosner, who I think I see at the back. You did come in, maybe you left. Oh, there you are. Thank you. Absolutely, moving around. Got that. So Randy and Neil, of course, were at the center of what happened in the financial crisis. And I'm going to lay out a few very, very simple ideas. I'm not a theorist. I'm not a complicated empirical person. I'm a data person, really. And I've got a couple of thoughts about the data that I would like to run by you guys and you guys. And you tell me if I've misunderstood completely what I saw and what you experienced nearly 10 years ago. The first thing I'd like to talk about is March 14, 2008. So this is a day, Randy just looked at me, he remembers that day very well. There were four members of the Board of Governors of the Federal Reserve available that day. Randy was one of them. Ben Bernanke, Don Cohn, and Kevin Walsh were the other three. And they took what I would argue is perhaps the most important single decision of the Federal Reserve, taken by the Federal Reserve Board of Governors in recent times. This was the day they bailed out Thornburg Mortgage. Oh, wait, I'm sorry, they didn't bail it out. Oh, I got that, I'm just reading my notes wrong here. Peloton Partners, no, didn't bail out Peloton Partners. Carlyle Capital, also not. If you read Ben Bernanke's memoir, it's a great memoir. Chapter 10, very carefully, he takes you through March 2008 and tells you about the pressure points and tells you about the companies that were on the brink of collapsing that could have been assisted, including Peloton Partners, a relatively small hedge fund, $2 to $3 billion. Thornburg Mortgage, $34 billion. Some interconnections, definitely. And Carlyle Capital, which was run by the Carlyle Group, but it's separate from from their main activities, that was absolutely invested in mortgage-backed securities. If you took these three companies together, their total assets were $61 billion. This is from Ben Bernanke's memoir. And Ben says that wasn't big enough to merit saving. We couldn't justify taking extraordinary actions to save those companies. And he expresses regret. He's sorry that people, for example, Thornburg Mortgage were caught up in circumstances, in his view, beyond their control. So who did the Federal Reserve save on March 14th, 2008? Well, okay, this word save, we've got to be careful, and I think it's fantastic that the Minneapolis Fed is taking this initiative. We'll take the emotion out, we'll get very technical, we'll try to be as dry as possible. The Federal Reserve provided, and you can correct me also, Randy, the Federal Reserve provided financial assistance to JP Morgan in order to facilitate the acquisition of Bear Stearns. And specifically in that transaction, very clearly and very deliberately, the executives of Bear Stearns lost their jobs. The shareholders faced a substantial loss. Exactly how much loss we can discuss, but no question, this is not a good transaction for them. The creditors for Bear Stearns were protected. And that's very important, I think, and that's the heart of the matter that we're discussing today. When various kinds of creditors get protection, when should they expect to be protected? If you lend to a certain kind of firm, forward-looking, where should you expect more protection in the modern economy? Now, Bear Stearns was, according to Mr. Bernanke's memoir, and I think this absolutely fits the data, about $400 billion in total assets, with lots of interconnections, exactly as Randy has emphasized, he and his colleagues emphasized at the time and subsequently. No question. 700,000 open derivative contracts, for example, 5,000 subsidiaries, transactions across the economy, absolutely. $400 billion. The credit was protected. Now, Lehman, so this is why I think this is when we start to think about, or actually this reminds me of a conversation I had with some hedge fund guys a few years ago now, where they said to me, I had the kind of discussion that we're going to have this afternoon, including all this back and forth, and they said to me at the end, they said, Simon, we get that, the hedge fund people, right? We get that, Simon. The question is, how do we get to be too big to fail? Right? So how do you get to be too big to fail? What are the criteria in the modern economy? So Bear Stearns got protection of $400 billion. And some people say, well, okay, I understand that, Simon, but what about Lehman Brothers? Lehman Brothers was not saved. It went bankrupt. That was about $640 billion, and a total risk exposure perhaps around $800 billion. Now, I think, so this is a good question to discuss exactly with the people in the room today. My interpretation of what happened is exactly what Ben Bernanke again says in his memoir, this time chapter 12, which is the Federal Reserve felt it didn't have the legal tools available. Nobody was able to purchase Lehman in the same way that a purchase had gone through with Bear Stearns, and they felt that Lehman didn't have good enough quality collateral in order for the Fed to provide assistance. So Bernanke says, explicitly, we knew it would be a disaster. And he was right. They're saying they didn't have an alternative. So at $400 billion, the conjecture was that if Bear Stearns fails, the credit fails, to be clear, and there's a default on the credit, that will cause chaos. And so they prevented that chaos. I was chief economist at the IMF at the time. I thought that was a good decision before they made it, when they made it, and right after they made it. And I fully support Randy and his colleagues in having made that decision for Bear Stearns. For Lehman Brothers, I think there is a lot of regret that Lehman went bankrupt, and I think that regret is well-founded and well-placed, not the least as articulated by Ben Bernanke, who says he didn't have the tools, and we'll talk about whether or not the tools have changed in a substantive way. Clearly, for $640 billion going on $800 billion, that collapse was very painful for the US economy and the global economy. And then we turn to Citigroup and Neil and his colleagues, who were on the hook because they had received the funding from the Emergency Economic Stabilization Act on the top. Citigroup was the largest bank in the world in October 2008. It had a balance sheet of $2.5 trillion. Does anyone in the room think that the Fed and the Treasury and Neil and Randy should have let Citigroup fail? I see no hands. Okay, thank you. That's a relief. Yes, I'm going to say, at the Minneapolis Fed, I was going to hope for at least 2 hands. 3 hands, Chris Cole, Independent Community Bankers of America, absolutely. I wish I could agree with you. I wish I could agree with you. But the problem is credible threats, right? The problem is the moment, March 14, 2008, or various moments I'm sure Neil can tell us about, when I don't think Hank Paulson wanted to do bailouts. I really don't. I think he wanted to be the opposite of bailouts, but he found himself in these moments where it's either provide the financial assistance, protecting the credit, irrespective whether or not bad things happen to shareholders and executives, but protect the credit, or face more dramatic consequences. I think all firms in this economy should be able to go bankrupt. I think an exemption from bankruptcy is a big problem. I don't think that's capitalism. I don't know what it is. It's not capitalism. But if you presented me with that decision for Bear Stearns or for Lehman, well, for Bear Stearns or for Citi, I would have made the same decision. Lehman, you didn't have the tools. I understand that. So I'll come back to this issue of size and numbers. But first, I want to put a couple other numbers out there. While we're discussing costs and benefits, I thought it was a great discussion this morning, by the way. I think this is a fantastic initiative to actually sit down and have the Federal Reserve, part of the Federal Reserve, I get that, think about the numbers, think about how we should measure some of these issues. Think about the costs of crisis, if there are costs of crisis. Absolutely. It's long overdue. So here's a couple of things to throw into the mix, okay, in terms of what was the cost of the crisis, the outcomes. Well, we absolutely, and I think this has already been the point that's already been made by Chari and others, we absolutely have to address what were the outcomes of this crisis. And I got 3 for your consideration. One is the lost GDP, right? This is a big number. This is something like 1 year's GDP lost that you don't get back to, we haven't got back to, $17 trillion, cost to the economy. The second is the fiscal cost. So if you look at the CBO did do this properly. The CBO has a projection of the medium-term budget deficit and debt that they do every year. And they did one right before the crisis became very intense, and they did one when the full intensity was known. And that swing over the medium term, over the business cycle of debt to GDP in the United States is about 50%, 50% of GDP. So when we do Deborah's analysis, for example, that's one number that should figure in that. But the third effect, and the one that I think people are most confused about, I don't think there's going to be confusion in this room by the time we're done, but the one that people are most confused about is the effect on the financial system itself. Now, Too big to fail has been with us for a long time, and I know that because I read the book by Ron Feldman and Gary Stern, Gary's in the fourth row, called Too Big to Fail, that was written in the early 2000s, and it's a fantastic book. In fact, if you're only going to read one book about the financial crisis, you should read my book, 13 Bankers. I'm sorry, did I say that? I didn't mean to say that. You should read Too Big to Fail by Ron Feldman and Gary Stern. And I think, but you can read it and tell me if I'm wrong, I think all of the economics that we've discussed today is in that book, including I guess we have to look at the foreword by Paul Volcker for one piece, Ron reminds me. Okay, Paul Volcker said, worry about the investment banks. But everything else is right center in that book. So too big to fail is not a new problem. But the scale of this problem, the centrality of it, the prominence of it, is new. Too big to fail. So what did too big to fail have to do with the last crisis? It's a fair question, all right? And we could agonize over that for a long time. I don't know. What I can tell you is the decisions made by the people in this room, for good reasons, responsible decisions by sensible policymakers, created the correct impression, deliberately, actually, by the end of 2008, 2009. I think the government was rather desperate to create the impression that big banks and other important financial intermediaries wouldn't fail. I think that was a struggle, actually, to get that message through. And the stress test in early 2009, I think, did achieve that. No more failures of highly interconnected, big impact, large systemic footprint finance. So too big to fail is an outcome, too big to fail in its modern incarnation, the kind that we're trying to end. I read the hashtag, all right? That was created by the crisis. So we need to think about this on a forward-looking basis. A couple more numbers for your consideration. So is Till still here? Till. I enjoyed your remarks this morning, but I didn't understand the capital numbers at all. Okay. I'm just a data guy, all right? So all I do, I'm just trying to understand the size of the banking system in the United States and the size of individual banks. It's not that easy. You know, there's different numbers out there. The Fed actually does give me a definitive number now. I can go to the systemic risk reports of every bank holding company, and on a consolidated basis, it shows me their balance sheet, including net derivative position, okay? And various measures of interconnectedness, the kinds that Randy emphasizes. So these are important numbers, I think. I mean, Till, you can stop me, okay, or correct me later. But I think what I want to understand is, and I think what you were talking about was how much, and what Anat is always emphasizing is how much loss absorbing capacity do I have in any banks? But I'm going to focus on the big banks, okay? Because the little ones actually fail all the time, right, Chris? And nobody complains and nobody notices and nobody gives you a bailout. So, different topic. But in the big ones, I want to know what's the risk exposure, what's the size of the balance sheet, but I want to include a derivative exposure, and that's obviously not the trillions of dollars of notional exposure. It's some measure of the net, which is what they have to report to the Fed now. And I want to compare that to shareholder equity. Randy made this very good point at lunch that we should improve, and this is a good point for OFR as well, Randy, because as you know, I'm on that committee with you. For some of our data, we should extend it backwards as well as worrying about getting the latest up-to-the-minute data. And one thing we should extend backwards is this systemic footprint, the total exposure numbers for the largest banks. We don't actually have that for many of them. We can construct it from annual reports for some of them, back to 2006, 2005. It's very hard to go back earlier for any of them. But what we can see, Till, and I'm happy to have this conversation separately and to discuss this with you. We'll show you our numbers and vice versa. What we see from the available numbers, shareholder equity compared to total exposure of the largest banks in the United States, this number was between 3 and 4% equity compared to total exposure, and now it's between 4 and 5%. So then I read Anat's books and papers and so on, and I say, okay, 5% loss absorbing equity, 5%. In today's world, with all the volatility and the shocks and so on, is that a lot or a little? I don't know. I mean, we could do risk-weighted assets. I mean, the only thing I know, okay, one of the few things I know is that the risk weights are always wrong. That's the point about sovereign debt. That's the point about mortgage-backed securities. Whatever you think the next crisis is about, the risk weights will be wrong. So, by the way, good news for Jim: the European banks are worse. They were 2 to 3% equity to total exposure. Now they're 3 to 4%. It's not that good a news, right? But it's something. So I don't think there's a lot of capital in the system. If there was a lot of loss-absorbing capital, I would feel quite differently about this problem. But there isn't in the largest banks, with the interesting exception of Wells Fargo, actually, has more. But not the big broker-dealer trading houses. Now, resolution. Resolution is a fascinating topic. I've spent a lot of time on resolution since the crisis. I'm on the FDIC Systemic Resolution Advisory Committee, and these people have worked really hard to make Title II and Title I, the bankruptcy part of Dodd-Frank, work. Will it work? I'm trying to be nice, guys, okay? I'm trying to be nice. I'm seeing them next week. It's going to be tough. Will it work for LTCM, 1% of GDP, WAMU, 2% of GDP, relatively straightforward. WAMU had losses for the creditors, by the way. Maybe. Will it work for MF Global, $40 billion? Will it work for CIT Group, $80 billion? Yeah, probably. You don't need it for those because they actually went bankrupt, which is what we're looking for, right? So will it work for the large, complex global financial institutions of today? Citigroup was $2.5 trillion. Total exposure today of Citigroup, end of last year, 2.8 trillion total exposure number. JP Morgan Chase, 3.7 trillion. JP Morgan Chase, by the way, is the largest bank in the world by about $1 trillion on an exposure basis, calculated, reported by the Fed. Is the FDIC's resolution power going to work for a bank operating in 100 countries with all these interconnections and the massive systemic footprint? Well, I would ask who would let JP Morgan fail if they failed today, but I think I know the answer to that. Only the guy in the front row and the ICBA. Okay, I'm sorry, the second row as well, I recognize that. No, the resolution is helpful. It was worth doing it. Don't abolish it, please. But it's not going to work for the mega banks. And the Volcker rule. I see people here from the Volcker, Michael, from the Volcker Institute. Look, I'm all in favor of the Volcker rule. As you know, I've testified many times on the behalf of the rule, and I think it can, at the margin, have some impact. Does it solve our problems, end too big to fail? No, and I don't think Chairman Volcker thinks that it does either. So what's my proposal? What's the idea that these gentlemen are going to take pot shots at, and then I get 20 minutes to come after them? So I took a flight from Washington, D.C. to get here this morning, and we're just about to get on the plane, and you know, the pilot gets off. Have you noticed this? The pilot walks around the plane. You ever thought that was kind of a strange thing to do in a modern technological age with all the systems and so on? Anyway, turns out we had a flat tire on the plane, and the pilot spotted it. Now, I think that's just a simple, let's walk around the plane and make sure nothing's hanging off it, right? This is not the Maginot Line. This is, I'm de Gaulle. We're all de Gaulle. We've got to be de Gaulle, right, Randy? This is something about wheeled, tracked, armored vehicles, I'm sure. This is simple stuff. I want a fail-safe. I want everything, all the sensible, reasonable things. I want to do cost-benefit analysis as defined carefully at the end of lunch. In a reasonable way, like as done by the Bank of England's Financial Policy Committee, for example. But I want to stack the deck a little bit more in our favor, a little bit more in favor of bankruptcy and failure being possible. And I think there should be a size cap on the largest banks. And when I look at the data, and all I have is the data, all I have is history, and I don't have that many data points. But when I look at the data, and I read the report that was done at LTCM, by the way, Ben Bernanke says very clearly, LTCM was about just over $120 billion exposure, about 1% of US GDP in 1998, on the brink of failure. Ben Bernanke says, in retrospect, all you get for $120 billion is coffee and sandwiches at the New York Fed. No government bailout money. They convened the meeting. They told the banks, their counterparties, to bail them in, and they did. Right? So I can see 1%, I can see 2%, I can see WAMU, the creditors lost. Hardly mentioned in Bernanke's memoir or most of the other crisis memoirs. That was not the big news of September or 2008 or the big disruption. So I'm saying this. I'm saying 2% of GDP. 2% of GDP hard, size cap. If you above 2% of GDP, then we put a NAT in charge of your capital requirements. I'm sorry. Then we have a much higher capital. We have a much higher capital requirement for you. And you decide. You decide. You, the management, you, the board, decide how you want to proceed going forward. But above 2% of GDP, I think it's very risky and very dangerous to let these banks and these firms continue in operation. Thank you very much.
First, thank you, Neil and Ron, for inviting me. This is a great occasion and an important one. I'm going to address the question today of, does scale define the winners in banking? And I'm going to look at the costs of breaking them up rather than the benefits that Simon was addressing a few moments ago. So cost, but not the benefits. And here are some of the questions I'll consider. Are there good business reasons for banks to be big? Apart from, of course, growing big to obtain too big to fail status. And if there are, would limiting their size or breaking them up work against market forces and create incentives to evade restrictions and perhaps new sources of systemic risk? And so we'll ask the question, do the largest financial institutions experience scale economies? And if so, how large are the scale economies? And if technological scale economies exist, is it possible they could be achieved by smaller institutions than the largest we observe today? And if scale economies exist, do they result from technology or from cost of funds subsidies? Because that's often an accusation made by critics. And if they're the result of technology, then what are the cost consequences of breaking up big banks? Would restricting scale reduce their cost efficiency and global competitiveness? And studies have found typically that there are economies of scale at all sizes of banks, that bigger banks enjoy the biggest economies of scale, the lowest average costs of products. Then are there good business reasons for banks to be big? Well, earlier research didn't find evidence of economies of scale at big banks. And the received wisdom on this point was stated by Alan Greenspan. For years, the Federal Reserve had been concerned about the ever larger size of our financial institutions. Federal Reserve research had been unable to find economies of scale in banking beyond a modest size institution. I'll emphasize that point. So is that finding credible? Textbooks assert that scale economies characterize banking. Large institutions have historically continued to grow larger. Larger institutions offer financial services and products that are not available at smaller institutions. Institutions merge and cross borders to create larger institutions. But becoming large, of course, could be simply to obtain too big to fail status. Well, here's a list of studies that have found evidence of scale economies at the largest institutions. This list is illustrative, not exhaustive. And I've put an asterisk by the names of authors who are former or current Federal Reserve economists. What do some of the critics of the largest financial institutions have to say? Well, Richard Fisher, hordes of Dodd-Frank regulators are not the solution. Smaller, less complex banks are. We can select the road to enhanced financial efficiency by breaking up too big to fail banks now. Sheila Bair pointed out it could be in the enlightened self-interest of shareholders to break up banks. And Phil Purcell quantified this claim, saying it would double or triple shareholder value of each institution. And last year, Richard Ramsden, an analyst at Goldman Sachs, suggested that JP Morgan Chase would be more valuable broken up into 2 to 4 pieces. And he did admit that it would be at the expense of $6 to $7 billion of what he called net income synergies. Now, Marianne Lake, the CFO of JP Morgan Chase, pushed back and said that JP Morgan should keep its current mix of businesses because it had around $18 billion of cost synergies from having all the lines under one roof. And then she made the rather strong claim, scale is always to find the winner in banking. What are scale economies? Well, scale economies tell us how minimum cost varies with output. A proportional increase in output that results in a less than proportional increase in cost implies economies of scale, and a proportional increase in output that results in a more than proportional increase in cost, diseconomies of scale. And so the cost elasticity, whether it's less than 1 or greater than 1, is the key point. Standard textbooks say we can expect economies of scale from spreading the overhead, from diversification of liquidity risk and credit risk. Relatively fewer resources are required to manage liquidity and credit risk, perhaps network economies in payments. And when studies are done of cost elasticity in banking, cost is regressed against output and input prices, and a common finding is slight economies of scale at small banks and scale diseconomies at the largest banks. Why is it so hard then to find evidence of scale economies at the largest banks? Well, endogenous risk-taking affects cost, and larger scale improves diversification. That is to say, it improves the risk expected return frontier of banks. It results in a lower marginal cost of risk management. And larger banks generally take more risk in response to this. And risk-taking influences cost. So let me give you an example. Here is a risk-return frontier for a smaller bank, the frontier for a larger bank. And because the larger bank is better diversified and spreads overhead costs and so on, the frontier shifts upward, improves for the larger bank compared to the smaller bank. Let's say the smaller bank is producing at the investment strategy at point A and gets bigger. Continuing to produce at that investment strategy of point A, it can now produce at A prime, which is the same return for less risk, or it can produce at point B, which is the same risk at higher return because perhaps of spreading the overhead. So when we observe the smaller bank producing at A becoming larger, continuing to produce at the same investment strategy, it's able to produce at A prime. And a cost study that looked at this and control for that investment strategy at A would find that the bank benefited from economies of scale, and even at point B, economies of scale. But typically what happens is the bank doesn't produce at A prime or B, it produces at C, and the extra risk-taking is costly, so it increases the cost elasticity, and you might find that that changes constant returns to scale if you are not controlling for the investment strategy at A. Or it might even produce more risk at D, and that risk increases the cost elasticity and you get diseconomies of scale. So if the standard study isn't controlling for risk-taking at point A, it's likely to find the problem that you've got diseconomies of scale or constant returns to scale rather than the true economies of scale that result from technology. This point was made in a different context by Becky Dimsetz and Phil Strawn, where they took a measure of bank-specific risk from an asset pricing model and regressed it against the log of assets and found that typically you get a little more risk with more assets. But as they control for what the bank was doing, they were able to find that the bank was actually less risky, was better diversified. So finding diversification required controlling for risk-taking, the investment strategy at point A. So there's a diversification effect, which is the result of technology, and there's a risk-taking effect, which can mask the diversification effect. And so the standard minimum cost function is often fooled by this problem. It identifies those points C and D. And what we do, Loretta Mester and I, along with Bill Lang and earlier work in Chungul Moon, is to estimate a rate of return function, which is something on the order of an asset pricing model. And we back out cost from that ROE function. So we're able to control for the investment strategy at A, and we then capture the technology while controlling for managerial risk preferences. And so we're able to identify the change in cost from A to A prime and find the scale economies. This point was made by Anna Kovna, James Vickery, and Lily Zhu at the Federal Reserve Bank of New York. They looked at operating expenses, overhead, and asked how overhead varied as the bank got larger. In particular, they looked at the operating ratio, the ratio of non-interest expense to revenue. And they found that a 1% increase in assets implies the ratio decreases 1.3% with no controls for what the bank is doing for its investment strategy. When they control for asset allocation, it decreases by 1.9%. And when they control for asset allocation, revenue sources, business complexity, and so on, it decreases by 4.2%. So finding these scale economies, it's essential then to control for what you're doing. Whoops, wrong direction. So they found A to A prime, or A to B rather than C to D. And in particular, they asked, what about the size of the institution? Well, for the smaller institutions, right up to the 99th percentile, it's essentially not quite different. But by the time you get to the largest 1%, it's quite a bit different. The largest 1% enjoy the largest economies, spreading of overhead, if you will. And work on total cost, not just operating cost. Loretta Mesternide, in a recent study, estimated standard cost function for U.S. banks over 3 different years. Mark Distra did this for European banks. And this is cost elasticity you're seeing reported. So it's essentially 1. A 10% increase in output results in a 10% increase in cost. However, if you estimate that risk-return driven cost function that I was describing, you'll find substantial scale economies. And if we were to take 2010 for US banks, a 10% increase in output implies essentially an 8% increase in cost. And when we looked at it by asset size, you'll see that when we get to the systemically important banks under Dodd-Frank, the cost elasticity is substantially lower than smaller banks. And I'll focus on that last number. A 10% increase in output implies a 7% increase in cost. That's consistent with about $14 to $19 billion in cost synergies at a $2.4 trillion bank, which sort of is consistent with Marianne Lake's $18 billion estimate. We've done robustness checks. We get similar results regardless of the year. We take 2007 data. We drop smaller institutions smaller than $2 billion, re-estimate the model, and get the same results. Then we drop institutions larger than $100 billion and re-estimate the model, and we get essentially the same results. Projecting for the largest banks, scale economies out of sample, and they're still the same results. So the results aren't being driven by the too big to fail banks. Then we try one more thing. We recalculate scale economies for each bank larger than $100 billion, and to eliminate any cost of funds advantage that they might obtain, we replace the interest rate paid on their 3 types of borrowed funds with the median interest rate paid by banks smaller than $100 billion, and we again get similar results. Large scale economies, the largest at the largest banks. So we conclude that these scale economies are the result of technology and not too big to fail subsidies. What are the restrictions? What are the implications for global competitiveness? Wheelock and Wilson, in a 2010 paper, took the 4 largest institutions in the US in 2009, over $1 trillion in assets, scaled them back to $1 trillion, and then increased the number of banks so that total assets was the same, and they got 9% higher total cost. Loretta and I did the same type of exercise, taking the 17 largest institutions in 2007, greater than $100 billion, scaled them back to half their size with the same product mix as the larger institution, and we increased the number of banks so that total assets of those banks were the same, and we got 23% higher cost. So what are the conclusions? Scale economies are hard to detect because costly endogenous risk-taking related to technological scale advantages tends to obscure them. And the largest financial institutions experience the largest scale economies. Technology rather than safety net subsidies appear to generate them. But there may be social costs of large banks, financial stability considerations that we're not looking at. So that's an important issue. In short, then, if effective size restrictions could reduce the global competitiveness of these banks, But size restrictions may not be effective since they work against market forces, and they may create incentives for the firms to avoid these restrictions. And by pushing risk-taking outside the regulated financial sector, it may result in systemic risk, new sources of systemic risk that were certainly unintended. So thank you very much.
I want to start by thanking the Minneapolis Fed for inviting me here. You guys literally, as Simon pointed out, wrote the book. Scott, if you could hold it up. There's my copy. I highly recommend it to all of you. I've been rereading it. I remember when we held hearings in the Senate in 2004 when the book first came out. And I mean, the Minneapolis Fed has been behind this issue for a long time. And I particularly want to thank President Kashkari, who has really created an awesome format and I think expanded the footprint of what a regional Federal Reserve can be in bringing us together to publicly debate this issue, which needs to continually be debated. The scars of the financial crisis have not healed, and there have been fundamental reconsiderations of what it means to be a bank charter. Banks don't get licenses, they get charters from the state. And in fact, we have a lot of them here. I wish little banks, we have thousands, 5,000, I wish banks of all size failed more. Does anybody here know the longest time we've gone in the US without a bank failure? Anyone? Guess a decade. 40s, 50s, 60s, 70s? The longest period was 2003 to 2006. And that was the single biggest problem that we had in the financial system. We have to get behind our mindset that failure is good and that failure of institutions of all size. If not a single restaurant in Minneapolis failed in 4 years, that's a bad thing. So I think we need to rethink about this, not just for large banks, but for banks of all sizes. So I kind of want to, in the spirit of the season, ask and pose 4 questions that should be asked of any breakup proposal, and then in my position here, kind of take a look at Simon's thoughtful idea and ask kind of how would these questions work. And I think I'm going to kind of complement Joseph's position very well because it's going to be very micro-focused. And I want to ask a very set of micro questions because it could lead you to a different perspective. For example, 90% of Americans disapprove of Congress. And in the election in November, 90% or more of congressmen are going to get sent back to Washington. So, you know, people don't like big banks, but where are they going? So the first question I'd like to ask is, under your plan, can I keep my bank? And so as I've kind of asked this question, right, because as I understand the kind of current proposal, the breakup the proposals tend to kind of have 2 different ideas. One is a size cap, which is what Simon's put out. Another is a function cap, kind of the modern Glass-Steagall to separate commercial and investment banking. And those have very different answers to this very simple question. So a cap on size would mean that millions of Americans would have to switch their bank accounts. Because once you hit that size, you couldn't get new deposits, or the banks would have to figure out how to kind of separate their businesses. So if not, what happens to me? Well, I'm going to have to change where I bank, which is, you know, that's okay. But what does that really mean? So we could never know because for most of the period that we've been collecting data, particularly after Regal Neal, big banks have gobbled up small banks. So we have no idea what consumer preference was. But after the financial crisis, big banks can't. So consumers can kind of choose which bank to go. And stunningly, they're going to big banks. Research I did at my previous job at the Bipartisan Policy Center showed that since the crisis, large bank consumer accounts for under $250,000 deposit insured have grown substantially faster than smaller banks. Why? I don't think anybody wakes up and goes, God, I want to be part of a big bank. I don't think big banks are getting some giant subsidy, and we can talk about that, and then not passing that subsidy to shareholders, not taking that in executive compensation and bonuses, and somehow competing that away to retail small dollar customers. So I don't think if you believe in subsidy or not, I don't think it's credible to say it's being passed through all the way to little folks. And if it is, okay, well, that's a transfer, and we can discuss that. I think it has to do with the technology points that Joseph pointed out. I point out for anybody here at US Bank, which would be above Simon's threshold, I think US Bank just came out with thumbprint technology for payment. That's really cool. I use that on Apple Pay. That's a lot better than non-thumbprint and putting in these complicated passwords. There are other technological benefits that I believe have grown faster in the modern world, like online banking and mobile pay, that are driving some of the returns that have been measured historically up. And so I think that you kind of have to start with that question. So then you kind of say, if so, what can I do at my bank? So this is not Simon's proposal, so I'll be very short on it, but the folks that want to separate and bring back a separation of asset class, right, that's okay. That could be beneficial, but think through what that means, right? I'm going to assume that you actually don't have loopholes. Glass-Steagall had a lot of loopholes that people got around, so I'm going to take the real version of it. So if you're at USAA, USAA can choose, do they want to be a bank or do they want to be an insurance company? But you can't offer both. That was actually the investment in commercial banking is the big deal that we're talking about, but the driving force behind a lot of the repeal of portions of Glass-Steagall and Gramm-Leach-Bliley was actually banking and insurance, which have shown not to mix. USAA is one example. But you can ask different things. At Bank of America and Merrill, okay, you're going to be separate. And so the question has to do with banks will then choose what services to provide me. My final point on this is the split-up process is going to be messy because as banks will want to shed their least profitable customers, right? But regulators have Fair Lending and Equal Credit Opportunity Act, and for those of you who've been in this room who've had to decide whether or not banks can close branches, it is not a simple question. And so there'd be a giant push-pull between industry and regulators as to how you get smaller. It's not as simple as I think you mentioned in lunch, breaking up the bells. And it becomes very tricky there. And those are very important issues in terms of access because, again, people want these types of larger institutions. Question 2, how does 3M bank? I picked any global company. 3M is, I think, one of the largest in this district. Simon pointed out JP Morgan operates in 100 countries. 3M operates in 200. They sell a lot of Scotch tape. How do they bank? How do they send money out? How do they get money? How do they move money across their distributors? Well, I think you kind of have two questions when you answer what are the ramifications for global businesses with no large US banks. One, they use a lot of small banks. Okay, that's probably, that works. It worked very well. We had lots of trade before mega banks and Gramm-Leach, Regal Neal. Probably more costly because the economies to scale. So that costs more money for 3M. Interestingly, by the way, that means more money for the smaller banks. So if you want to drive down 3M profits and up profits to the agglomerated banking industry, that would be a ramification. I'm kind of against that, but different people can have different perspectives. It's why it's important to think through the question. The other alternative is they say, you know what, there are lots of giant global banks that operate in these 200 countries that aren't American. We're going to go to our global bank. Okay. So we're going to move that business offshore. Maybe that's good. It creates more financial systemic, creates a more stable system. If you believe that somehow their banks won't export a financial crisis into our system, we certainly did a good job in the last crisis of exporting our problems overseas. You know, does that also mean that you lose the underwriting and the other affiliated investment banking business? I don't know. It presumably would mean a change of jobs overseas. Okay. Question 3, what does this mean for U.S. capital markets? So this one is very ephemeral, right? Capital markets are big and important. What do you really mean? Well, so who uses capital markets? Minnesota. Minnesota will issue $1.5 billion in debt this year, according to the governor's request. How will they underwrite it? Who will buy it? How much will it cost them? If you believe that the investment bank, commercial bank agglomeration produce economies of scale and synergy, then you have to ask the question of how is that distributed between the financial sector and issuers of debt, whether it's Minnesota or General Mills, and what will their cost of capital be? The U.S. capital markets are awesome, and we ought not to take them for granted. When I was at Treasury going around the world, I went to a lot of countries who were trying to figure out how to sell infrastructure debt, how to access capital markets for their financing needs, and get things out of bank balance sheets. I was blown away in India that when a state wants to do an infrastructure project and run a deficit, it goes to the Central Bank of India, who then looks at the roster of banks in their country and assigns a match. And then that match is given a variable rate loan to the state. So when the central bank raises interest rates, they've raised the debt lever on the state government's municipal boundary. I can't imagine a system more different than what we have here, and I can't imagine the Federal Reserve would be thrilled in being that matchmaker, nor should it. I'm not proposing that as an alternative. What I am proposing, and what you have to think through, is for debt issuers, and then debt buyers, paradox on the other side, what are the costs of this kind of restructured system? I don't really know the answer to that in Simon's proposal, and I look forward to understanding that. Part of it depends on assumptions of what these $350 billion capped institutions do as a mix between investment and commercial, and what assumptions are in capital markets with kind of smaller intermediaries, or are there standalone folks that go up to 350 or above. By the way, I kind of want to point out, as I'm going to turn to this question, are we sure Dodd-Frank didn't solve the problem, is that there used to be 5 standalone investment banks. 2 failed. The other 3 are now bank holding companies. So when we use the term bank, we tend to be not very clear about it. Are we talking about a commercial bank, an investment bank, a mixture? There are Raymond Jones and Jeffries and standalone investment banks who are not regulated by the Federal Reserve, not subject to prudential regulation, and does the cap apply to them? Does the cap apply to non-bank SIFIs? Is the cap just on commercial banks? Where does the cap go? Where does it end? What are the boundaries? So Dodd-Frank tried to solve this problem by creating the bank SIFI structure and the non-bank SIFI structure. We can ask whether or not that's working or not. I'm a little bit in the tank for that, having worked for Senator Dodd and worked for the Obama administration. But I think we have to seriously think, did Dodd-Frank solve this? We cannot look at our current, the financial regulatory system going into the crisis and compare that to what we see today. There was a giant sweeping change in between. GAO has found that as a result of that change, the subsidy for too big to fail banks has mostly gone away. People can agree or disagree with their kind of meta-analysis and reading of things. But I think what you can't do is ignore the question of whether or not Dodd-Frank made a difference. And you have to ask, how does your plan integrate with Dodd-Frank? Is it a rejection? Is it a substitute? Or is it a complement to the Dodd-Frank structure? There may not be right or wrong answers to this, but you've got to ask that question as it integrates into a completely different system. The biggest topic I've heard discussed today here is, does too fail work? So I think of too big to fail and our great hashtag as 2 separate concepts. Do you have a problem with an entity that's too big? Or do you have a problem if a large entity can't fail, or any entity can't fail? I think the topic of CIT was brought up earlier. CIT did go bankrupt after it was bailed out. And the story of CIT is highly illustrative. I've thought about it a lot. CIT in 2008 was not that large, but had a substitutability issue. It did a certain type of lending to small and medium markets called factoring that Neil knows better than anybody else in this room. People weren't sure how systemic their collapse would have been in December of 2008, in that moment. And again, Neil's speech at Brookings and Simon's concept earlier, risk rates are always wrong during a crisis, is so true and has to permeate your soul as you think about this, because you're in the crisis because you got it wrong. If you saw it coming, you avoided the crisis. So if you're in the crisis and you got it wrong, is it substitutable? You don't know. There's tremendous uncertainty. So on December 22nd or 23rd, just before Christmas Eve, CIT received a transition to a bank holding company exemption, and December 31st, they got $2 billion plus of TARP funds, and they held along for a while longer. By June of 2009, they asked for more TARP money. They asked for a FDIC extension of the TLGP. They were turned down, and they went bankrupt. And the world didn't fall. Absolutely right. By what we know as a fact is in June of 2009, CIT was not systemic. We don't know what the effect of that failure would have been in December of 2008. And if you think that effect would have been the exact same in June of 2009, I would believe you're wrong. We don't know how much of a difference it would have been. But you have to constantly think about that moment of crisis. And so the question I pose to any bank is, what in Dodd-Frank failed that this proposal does better? Is the argument that, I don't know if Title II will work. I think it will. a lot of bipartisan scholars have. I noticed Randy Gwynn is here. He and John Bevenzio, I think, is speaking at the next one. It's on the brochure. Have done a lot of analysis on this, and they're fairly optimistic. I point out that the word single point of entry, which is the cornerstone of the solution, appear nowhere in Dodd-Frank. So it goes to show how much regulators have innovated on this concept. I can't tell you in this room that all of you will get home safely. If I made you a guarantee that everybody in this room will get home safely, 100%, I'd be lying. Nobody can offer you that kind of guarantee. What I can tell you is I don't think we should all spend the night here. And as much as I enjoy the company, we are all going to go home, and we're going to take that level of risk. And you have to decide what level of risk you're comfortable with in order to avoid the type of paralysis and analysis by paralysis that Randy eloquently discussed, that I associate myself with his remarks, that we don't want to fall victim to, and we want to ask ourselves, what are the solutions we have, and how does any breakup solution integrate or improve upon or replace Dodd-Frank? Thank you.
Like Simon, I'm an empirical guy, kind of simple. And so I wanted to go back to lunch today where Randy gave this great talk. And if you remember during lunch, the microphone went off and there was an assessment of the problem. The microphone didn't work. And then there was a solution to the problem. Replace the microphone. The solution to the problem was not to get a projector and a computer so that Randy could project a PowerPoint presentation that he doesn't have. And that's going to be the theme of my talk. So this is kind of perspectives on breaking up the big banks. So I wanted to start out with the big picture. And this is an argument that I used to have when I worked at the Fed and when I worked at the World Bank and when I've been a consultant at the IMF. And that is that banks do a lot more than fail. Okay? Banks decide who gets to start a business and who doesn't, who gets to expand a business and who doesn't, who gets to borrow in order to live in a community that's conducive to the cognitive and non-cognitive development of their children, and who doesn't. And banks matter for people who are essentially never going to get a loan or really use any sort of a complicated financial product, because by deciding on the allocation of resources, banks decide whether it's a dynamic labor market or not a dynamic labor market, and the opportunities available to us and our kids. So getting financial regulation right is, to me, first order. And it's first order not because of crises. It's first order because of the core financial services that they provide that affect the allocation of capital. For example, we talk a lot about the crisis. If you plot real per capita GDP over the last 100 years or so, you will not be able to tell that there was a financial crisis in 2008, 2009, 2010. And in 20 years, when you go to your kids or your grandkids, depending upon your age, and you say, where was the global financial crisis? They won't be able to point to it unless they're told. So regulatory reforms have to be geared and evaluated in terms of the impact that they have on these key financial services, whether it's mobilization, allocation of resources, exerting corporate governance, and all the rest. The breaking up the big banks proposal doesn't do this. And it sounds good. Banks are big, maybe they're too big to fail, so let's make them smaller. But I want evidence about how this is going to affect, A, whatever problem there is with too big to fail, and most importantly, the provision of financial services that are essential for prosperity. And without any coordination, but however, probably my guess is the source of the theme of 4 questions is probably the same. I'm going to come up with 4 questions, only one of which overlaps. So the first is there a too big to fail problem? And since you did such a great job, can be short. The other question is, what is the primary problem with too big to fail? And would breaking up the big banks be the best way to address whatever this core problem is? Would breaking up the big banks actually fix that problem, and is it the best way? Okay, so is there a too big to fail problem? And the last part here is, if so, should such a core failing with Dodd-Frank be dealt with in a piecemeal manner? Okay, so if a big focus of Dodd-Frank was to directly address too big to fail, and if we believe that it really has failed in that regard, is that the only thing you want to focus on, or the most important thing? Okay, so one argument is that Dodd-Frank effectively fixed the too big to fail problem. And there's many elements of Dodd-Frank and some of the reforms that came since that were designed to deal with that. Some of it has to do with too big to fail in general, or in particular, and some has to do with trying to reduce risk-taking by bank holding companies more generally. And I think there's probably broad consensus that it didn't fix it in completely, but there's an issue out there about whether it did or whether it didn't that's sort of not really, that's not sufficiently addressed. Second argument, and this is I think what Simon said, and I'm probably fall into this camp, which is that it may have done some good. I actually am less optimistic about Dodd-Frank. I actually think it has made the situation much worse. Why? So for example, once you have a statement that the Federal Reserve is basically going to take care of all systemically important financial institutions, if you want to talk about a problem of moral hazard, that pushed all of the chips onto the table for institutions that I think would never have been viewed as something under the purview of the Fed. So that's sort of this third argument. The Dodd-Frank and Basel have just failed miserably in terms of the incentives that they provide to the executives of banks in terms of the allocation of resources, provision of services. And if that's the case, I think we need a much deeper rethinking of supervision and regulation. That's my own view, but that's not the theme here. I guess everything is going to be my own view, but the other views will be on the theme here. So what's the primary problem with too big to fail? So I think that first of all, I think the reason why you get the economic reason for why you get too big to fail is that there's a sense that if this large financial institution fails because of some subset of its assets are no longer viable, that this is going to hurt all of the other good firms because of the relationships that they have with those other good firms. Those other good firms won't be able to get credit from other types of banks. So that is in some sense the economic essence of why economically we think that there's too big to fail. However, okay, when we actually look at what happened, okay, so who was the CEO of Goldman Sachs like before the crisis? Oh, and who's the CEO now? Okay, so it's one thing to bail out financial institutions because you're afraid that the firm's specific human capital within that institution, the connections that they have with their clients, is going to vanish if you let the financial institution fail. That would be the economic reason. But what happened? The bailout was for the individuals. Okay, it was essentially a check to these institutions. It wasn't simply addressing the problem, like the mic failed. This financial institution failed, and we don't want clients that had nothing to do with it to fail. No, that wasn't what they did. What they did was they bailed out the bankers, not just the bank. And this happened across the board, very much unlike General Motors, by the way. So the first issue that came up, and this is partly the discussion this morning, was about saving the taxpayers. Okay, and that if we don't want the taxpayers to be hurt. To me, going back to what I originally said, I think this is secondary. Okay, indeed, many of the people who led the saving of the US economy in 2008, 2009, 2010 argue that all of that stuff was paid back. Okay, I haven't seen any convincing evidence that what caused an enduring recession was the added burden on taxpayers. I don't think that was the essence. Okay, so I don't buy the story that the main issue and the main problems with too big to fail is that it puts the taxpayers at risk. Okay, so what do I think is the main issue? One is that the primary problem with too big to fail is that the big banks influence regulators. So I've written a lot about this, and I think that this was very true. I'm not sure that it is not still true. It's not clear to me that if we went to the 2% rule that all of a sudden the smaller banks wouldn't be able to coordinate. But this political issue is, I'm not taking this off the table. I think it's an issue, but I'm going to put it aside for now. So I think that the primary problem with too big to fail is that it distorts incentives. I want to come back again and again and again. What are the incentives for the decision makers in financial institutions in terms of the allocation of credit and the provision of financial services? Because that's the ball game in terms of influencing how economies evolve over 5 or 10 or 15 years. It's the incentives of the decision makers in the financial institutions. There, the issue about too big to fail is very straightforward, that with too big to fail, the debt holders won't monitor what the managers and the executives are doing effectively, and this might lead the managers and the executives to take on too much risk or to not provide very effective financial services. I get that. So that's what I want to focus on. That's the ball game. So would breaking up the big banks fix that problem? Okay? So, it might. Okay? It might, but you need, I think, at least 2 conditions. One, if it reduces expectations of a government bailout of the debt holders so that the debt holders would monitor more. You need that. They have to monitor more. And then you need that if the stronger monitoring, will that actually improve the governance of a bank, the banks, in a way that improves the services that banks provide to the economy. Under those conditions, this could be a good policy. But it might not. And so I want to go through these 2 conditions. So one, it might not reduce expectations of a government bailout. And Randy brought up some of these, and some of the other discussants have brought this up. There might be too many banks to fail. So that may be an issue. They may be too interconnected to fail. Regulators might fear cascading problems so that it doesn't matter. Basically, no financial institutions would be allowed to fail. Indeed, if you go back and you look at the material loss reviews that are done by the FDIC for all of the banks that failed during the crisis, if you go back and look, in over 80% of the cases, the FDIC identified the problem that led to the bank failure 2 years before the bank failed. And in 95% of those cases, the FDIC did nothing. So it's just not clear to me whether sort of getting this better monitoring by any entity is going to improve the governments by all that much. Or that the regulators would not bail out the banks anyway. Also, small banks are going to strategize. If it means that you have to be too complicated, too integrated to fail in order to get the savings, they'll become that. Even if it boosts monitoring by debt holders, breaking up the big banks might not improve the governance of banks. The governance of banks is a super complicated issue that also involves who's the owner of the bank. Okay? That's always a good question. Who are the owners of the banks? Okay, basically, in the US, there are no large shareholders in the largest banks. So when you talk about the governance of the banks, there's a tremendous problem with the corporate governance structure that exists in banks. And it's not clear that simply by having simply by intensifying the degree to which debt holders monitor banks, and it's only going to be effective if it's a large debt holder with the resources and the incentives to undertake that type of governance and monitoring, it's not clear that that's going to actually improve the outcome of the banks. Banks may raise money through other mechanisms, smaller debt holders that are not going to be less effective at monitoring them. It's not clear to me that breaking up the big banks is going to deal with the essential issue, which is the incentives of the decision makers in the banks. So is breaking out the big bank the best way to do this? And I don't think so. I think that breaking up the big banks might hurt the services that are provided by banks, whether it's economies of scale or economies of scope. And I keep coming back to this issue. If the issue is the incentives of the decision makers in banks, financial regulation and supervision should be geared toward fixing that issue. And there are a variety of ways to do that. Okay? One of the ways to do this would be clawback provisions. People may not like that. One of the ways to do this would be to force, rather than have a regulatory system that prohibits banks from having a large owner, you could have a system in which you force banks to have a large owner. You could alter the compensation system for bank executives such that they have more skin in the game. But you want the decision maker to have more skin in the game. Okay? you don't want raising more equity, the way Anat has emphasized, will do exactly what she said. There will be a greater cushion before debt holders and taxpayers get hit. Given. Will it improve the incentives of the decision makers in banks? I don't know. I don't think so. They're going to raise equity, perhaps from very diffuse shareholders that are not going to be able to exert corporate governance on the decision makers in the banks. Okay, yes, no, I'm not disagreeing. I'm emphasizing it here. And so that's the ball game. Okay, I think there's way too little focus in supervision and regulation on what are the incentives of the decision makers in banks. And that's primary because they provide services that are crucial for promoting economic prosperity in the long run. So summing up, banks are crucial. Before designing any sort of policy, including breaking up the big banks, I want to know exactly what the problem is, and I want to kind of directly assess those particular features. And I don't see that yet in the breaking up the big banks proposal. So, thank you.
Well, I'm as usual slideless, so you'll have to just bear with me and listen. First, let me say that this is really an honor to be here today, and I want to thank Neil and the Federal Reserve Bank of Minneapolis for hosting this conference and providing me the opportunity here today. This is a really important conference, and it's an honor to be among so many distinguished colleagues. Simon, Joe, Aaron, and Ross are a marvelous presenter and panel, as was the morning's panel. And you can't help but be in the presence of Ron and Gary Stern and supervisors like Kathy Lemieux and this whole group. Every table has distinguished colleagues who know a great deal about these issues. So it is a bit humbling, I have to say that. Now, the Minneapolis Fed has a proud tradition and a well-deserved reputation for thoughtful and scholarly engagement in important financial questions. And I'm confident that it will approach the weighty questions we are here to discuss, because this really is important stuff, obviously, with a great deal of care and academic rigor. After all, that's one of the things that distinguishes our country's regulatory officials, the independence and professional care that they devote to important questions like these. I mean, the Federal Reserve has a proud history, as do the other regulatory bodies, of distinguished study and serious and honest evaluation of questions before them. Now, I have over many years thought a great deal about U.S. banks and their role in the economy, both from a historical perspective and what the role is likely to be in the future. The question of whether we ought to place limitations on the size of U.S. banks is an important element of this larger discussion, from which I draw principally two conclusions. The first is that no one can answer this question right now with a scientific certainty, indeed with any reasonable amount of certainty, one way or the other. And the costs of acting wrongly here are profound. In other words, if we make a mistake here, this is a big deal. I'm on record of saying for many years that bank regulators should not regulate by hunch. And I think this same standard must apply here. We should not set policy by hunch either. I think this is a huge mistake. In many ways, bank regulation has over the last decade or so come in an enormous way, but we are still very much in a state that was equivalent to the medical industry prior to World War II. Prior to World War II, it was expert judgment. There wasn't a scientific method applied to medicine, and accordingly, we made as many mistakes sometimes as we made advances. And that's where we are. We're just emerging. This is sort of like a butterfly coming out of the cocoon in terms of bank regulation. Now, furthermore, my years of observation generally lead me to conclude that acting on hunch here and breaking up large banks or artificially limiting their size is not the right answer. There are considerable consequences of taking such steps, including a diminution in the well-being of the U.S. economy, and the very real possibility that such steps will actually increase systemic risk. It might increase systemic risk, which leads me to my second conclusion. I think this policy question ought to be more securely anchored in relevant, academic, and rigorous social scientific study. In that regard, I thought the presentations here today really advanced the ball and the studies that you all are engaged in. Now, I'll expand on this point at greater length in just a moment, but first I want to thank Simon for the work he has presented today. While I don't reach all the same conclusions he does, this is precisely the sort of forum for us to consider these significant questions together. Before we embrace a proposal such as Simon's, we need empirical evidence to gauge its implications. A policy with such wide-ranging impact on the United States, its economy, and its citizens demands deep and careful attention. I mean, the application of Simon's policy would have profound impact. And it seems to me in something this important, we want to know what happens before we leap. In other words, and that's really the gravamen of what I'm here to say. Now, before discussing some of the policy implications, I must confess that I'm worried about the practical and operational consequences of a cap or a breakup. Let me just touch on two here, and there could be dozens actually. Large U.S. companies like General Mills in this state, and in many parts of the United States, and indeed even the U.S. government itself, rely on large multinational U.S. banks with multiple offices in many countries as safe and reliable places to effectuate their payments, trade finance, and other financial needs. The decision to go to our large banks for these functions is not a matter of affection. It's not a matter of law. It's a matter of marketplace realities. Large U.S. companies and our government need this kind of financial facility to function. If our large financial institutions did not exist, where would our companies and government get these services from? From foreign banks? Would that lower systemic risk? Why do we have any assumption that if they go to foreign banks, it's going to lower systemic risk? Would that help the U.S. economy? Or perhaps these customers would go to the rapidly growing shadow banking system for these services. Would going to these unregulated vendors lower systemic risk? Would that improve the... We don't know the answers to these questions. Now, I'm a huge fan of community banks, and I think one of the richness of America is that we have, in fact, banks of all sizes and shapes. But before we decide that basically huge consortia of smaller institutions are somehow going to fulfill these responsibilities all over the world, we better take a look at this. Are they capable of it? You know, are they going to be able to set up offices in Uzbekistan and Sri Lanka and do payments in Southeast Asia? I don't know, but we ought to look at it. Now, consider also what would happen if we said no bank could be larger than $350 billion. Again, just practical implications. The economic value of the companies above the cap would fall off a cliff. That would have a devastating effect on shareholders, including 401k investors and pension funds. Chopping these companies into smaller pieces represents a considerable reordering of products, services, and capital, a process whose inherent inefficiency would be substantially worsened by the legal threat of failing to do so. The prospect of fairly priced asset sales seems unrealistic given the small pool of potential buyers, most of which are currently beyond the reach of financial regulators. So just imagine, just think of it practically. So you're going to break up the big institutions. They're going to have to sell things or do something with them. I mean, maybe sometimes you can IPO them, but who's going to buy them? How many buyers out there will be for these big pieces? And if you have 2 or 3 buyers, it's kind of like selling your home in a storm. One of the reasons I'm very skeptical about mark-to-market accounting is that I think of a home sale in a crisis. If I said, look, I have to sell my home and it's in the middle of a crisis, I can tell you I'm not going to get much money if I have to sell it in a day or two. And it's just, it can be the same here. In short, the complications that arise from implementing a cap bolster my position that we have not done enough relevant and rigorous scholarship on questions about systemic risk or the benefits as well as the burdens of financial institutional size. That is not to say that the idea of breaking up the banks has not been discussed. It's been discussed a great deal. But I've yet to see convincing research on what happens next, on what the impact would be of imposing a hard cap on bank assets. What research I have seen suggests that a cap or breakup would have negative consequences for the economy. Now, furthermore, I suspect that rather than size, the bigger risk is the interconnectivity and dynamic nature of the financial markets. Markets that today are ever more technologically driven and populated by entities that are wholly unregulated or lightly regulated. I'd also put in the bigger risk category the development of asset bubbles within and without the regulated financial sector, particularly our ability to identify and ultimately control these bubbles before they burst. But again, these are questions that need serious study. Now here I think it's important to ask ourselves, how fail-safe can we make our financial markets? A point was just made. Do we want to regulate to the point that failure is not an option? And is this even possible irrespective of capital levels? After all, some of the most serious financial crises of the past eras took place at a time when our banks, largely small banks, were generally thought to have strong capital levels by any standard. So in other words, one thing is with going through the Great Depression, there weren't any large institutions. The greatest systemic event in the history of America was a time where there were no large institutions. So why is it that large is the big bugbear here? And number two, when you go back to the wildcat banking era, and even any era prior to FDIC insurance, these small institutions were heavily capitalized. And that's some of the ways they convinced people to put money in their institutions, was how much capital they had. There again, there's no, as far as I've seen it, I haven't seen comprehensive studies, but the suggestion that it sort of didn't do the trick. Now, the same was true in the S&L crisis, the late 1980s, the dot-com bubble, and 2000 commodities boom. It was not a big institution issue there. And the ongoing post-mortem of the global financial crisis implicates non-banks as its root cause. In fact, in that event and others, large banks played an important role as absorbers of risk. We forget that it was U.S. government policy in a lot of ways, and also need, that actually caused some of these large institutions to become so large, right? Smaller institution has big problems. U.S. government wants to solve problems, doesn't want to pay out taxpayer money, so they say to large institution, why don't you buy that one? Why don't you absorb this one? That's been a history in the United States for a very long period of time. And so one of the reasons we have some of the institutions, as huge as they are, it wasn't organic growth or greed, it was the fact that they were available shock absorbers. Well, we see this even in the smaller institution arena, right? If there's a medium-sized institution that could absorb a couple of failing small institutions, we encourage them often as regulators to go ahead and absorb them. And that's been policy for years and years and years. Why are our banks the sizes they are? Because as I noted earlier, their customers rely on their scope and scale. Companies like General Mills and 3M here in Minnesota rely on banks that can serve their needs around the world. Beyond providing an efficient and essential source of credit, large U.S. companies use large banks to hedge their risks, finance trade across borders, manage liquidity, make payments, and collect receivables around the globe, and many other services that smaller banks have not been able to organize themselves to do. Now, forcing a breakup of the largest banking organizations in the United States is possibly an antiquated notion in a global economy. Now, we ought to study this, but it may be the wrong folks. It may indeed, as Ross said, be more an individual, the manager's issue. But we haven't studied enough. Again, I come back to this. I don't have the answers. I have suspicions and worries, and I've done this a long time. But we're just beginning to do better and better and better quantitatively, whether it's historical work or it's a kind of academic and quantitative work that we just heard about, which is from Joe, which is terrific. Now, as commerce grows, irrespective of borders, the U.S. puts its economic prosperity, it seems to me, at risk if it chooses to ignore the trends towards largeness. But it may be that the diseconomies of scale outweigh them. We, don't really know that yet entirely. International competition is already having an impact. Banks dominate world rankings. By the way, the comment was made that JPM Chase may be the largest. I don't know who the largest is, but I do know this, that I think if you look at all the data, the U.S. banks have, relatively speaking, become smaller as part of the largest crowd of global financial institutions, not larger. That is, the largest institutions in the world as a group, top 20, top 10, are actually outside the United States. Now, what's more, the breakup of large banks is likely to shift financial activity to much less regulated entities. I can see my time is up. I get red flags, so I'm going to skip a bit of this. But I'd say one other thing, and I think this is important. Our government has already taken significant and comprehensive steps to ensure that large banks are much safer than before and are no longer too big to fail. I mean, almost everybody in this room has participated in that in one way or the other. Before we break up or turn our large banks into utilities, shouldn't we take stock of how these very strong government actions are working? In other words, some of them are just being put into effect now. And just think of the list. Heightened supervisory standards, higher capital requirements, stronger liquidity requirements, more transparent disclosure requirements, limitations on products and services, limits to derivatives trading activities, hedge fund and private equity investments, stress testing under CCAR and DFAS, resolution recovery planning, risk-based compensation. This is not an insignificant list. This is transformational. And a lot of these changes which have been announced are just now actually being implemented in these financial institutions. There's tremendous press, as many of you know, in changing their back offices and changing their technology platforms, changes that take several years to implement. So before we go leaping into more change, it could be that more change will actually create more problems, more systemic risks. Again, I conclude by saying I don't know the answers, but I do know this, that if we don't study these issues carefully, and that's to laud the Minneapolis Fed for raising these things and discussing them in this kind of serious forum, and the forums are going to have, and then I hope to get back to the kind of studies that we've seen from this academic community, we have a tremendous danger of beggaring our own economy, which will have its own implications, including for the safety of these institutions, and also creating a situation that increases systemic risk for the country, not solving it. So again, thanks to Neil for having me here today, and to Simon for his efforts. These are important topics, and I'm pleased to have had the opportunity to discuss them with you a little bit. Thanks so much.
Well, thanks very much for such a terrific set of comments. This is the best attended, like, end of the second session after lunch I can ever remember going to. The audience is tense. Well done, Neil and colleagues. So the discussions have made a lot of very interesting and detailed and nuanced and complicated points. I think it's actually really much simpler than that. And maybe it's too simple. Maybe I'm thinking about it the wrong way. But I think it's really quite straightforward. And I would put it like this. At one point, none of us have mentioned, I forgot to mention, it didn't come up, is that having big banks in the United States, at the scale that we're talking about, the scale that I'm concerned about and that you're comfortable with, it's quite recent, 20 years ago. Most of these big banks were actually relatively small. Goldman Sachs in 1998, just looking at Neil, reminds me, Goldman Sachs was $250 billion balance sheet, that's about $300 billion, coincidentally, in today's money. It grew substantially. All of the investment banks and some of the larger commercial banks grew. Goldman Sachs, when it failed, ran out of liquidity in September 2008, was $1.1 trillion. So the way to think about your question, so obviously the hypotheticals, Gene, are always going to be hard, but one way to get at your question, and I think a reasonable way, is what did we gain as the banks became larger in absolute terms, in dollar terms, and relative to GDP? What was the improvement in services or types of products or lower interest rate spreads or better risk management practices or better functioning multinational companies, a number of you made? Well, I wrote a book on this. I'm happy to send it to all of you. I'll send you the Feldman and Stern book as well. We looked at this evidence, Gene, as much as possible. We couldn't find it. Couldn't find. What's the social? So private gain is interesting too, right? Is there profit? Presumably Goldman Sachs wanted to get bigger. It made sense from a commercial point of view. I get that. But what was the social value to that? What did we get as a society? And by the way, the thing that puzzled me about your fascinating points, Joe, I didn't understand the data at all, because you were showing me results, financial results that include 2010. Well, all the financial companies that in the large end, with one exception, arguably, at the large end of our data for 2010 failed and were rescued. Either failed or were rescued, or both. And you said, Aaron, I think that 2 out of the 5 standalone investment banks failed. No, they all failed. They all failed. Bear Stearns we talked about. Lehman failed. Merrill Lynch was on the brink of failure and it was rescued. Goldman Sachs was turned into, and Morgan Stanley became bank holding companies because there was no alternative. They were about to fail. So when we, and I hope that you'll share the data with the Minneapolis Fed, and we'll share our data with anyone who's interested. I don't understand these results on efficiency and on the gains that these large banks had if we're using data that runs up to and into the crisis, let alone subsequent to the crisis. Now, the key question again, to come back to this, is, I think, very simple and straightforward, the question that Neil grappled with and that Randy grappled with, which is nothing other than having a market economy in which firms can fail. I mean, yes, we can do cost-benefit analysis, and I'm absolutely in favor of you spending the next 9 months doing this. I'm happy to come to Minnesota as many times as you want until it gets cold again. Well, I guess it is cold, actually, still. But can a firm fail? It's very straightforward. Do you have capitalism or not? You may not like capitalism as a type of economy. That's kind of a deeper question, but I like it, and I don't see how you have capitalism if anybody has an exemption from bankruptcy. And by the way, it's the law. Go away and check Dodd-Frank. Dodd-Frank says that every financial sector firm must be able to fail. That's the Title I requirement. That's why you have the living will. The living will is supposed to be the firm's demonstration that they can fail, as in restructure their debts without causing a systemic shock or significant negative impact. And just in case, and the Fed and the FDIC have to sign off on that, and that rather eloquently pointed out we're having some problems with the implementation of the living wills. Title II, the resolution authority, only exists as a backup, as a fail-safe, type of fail-safe, or if, surprise, surprise, the bankruptcy doesn't work, then we can fall back on Title II. So this is the question for you, for Neil and his colleagues. It's very simple. Just work your way down the financial institutions. JP Morgan Chase, $3.7 trillion systemic footprint, right? 3.7 trillion, that's about 40% of US GDP. Can it fail? If they're on the brink of failure, they're running out of liquidity, can they fail? That means no government assistance. Yes or no? It's a very straightforward question. Maybe we have qualms about JP Morgan Chase. Citigroup, Bank of America, $2.7 trillion total exposure. Can they fail? You work your way down the list. At what point, for what size? Maybe it's not 2%, maybe it's 3%, maybe it's 4% of GDP. Maybe my limit's too high, right? If you think LTCM was actually a form of intervention, or if you think that the CIT group, we should take that seriously for December 2008, then maybe the size cap should be smaller. And I agree, we should consider these various questions. Can you keep your bank, Aaron? Yeah, of course you can keep your bank. I mean, the management and the executives and the boards are deciding what they do with the bank. We're just setting a capital requirement. And capital requirements, Gene, I understand the no policy by hunches, good idea. I mean, these guys were rather on the spot with having to make a lot of policy by hunches in the crisis, right? We're trying to prevent them or their successors from having that situation. So we're setting a capital requirement, Aaron. We're phasing it in like we do with Basel III. I know there were many dire warnings about the effects of higher capital requirements under Basel III. Those have not materialized. That's exactly what you're doing in terms of implementation of this, and you're phasing it in over some, period of time. Basel III likes 5 to 8 years. You can do the same thing. I am fascinated, really fascinated. Actually, this reminds me, Neil. Perfect thing for you to do is have some panels with CFOs of these major non-financial companies, which you have here. Have them come in and talk about the financial services that actually, you should talk to them in public and in private. They don't always say the same thing in private. But ask them in private, do you need the mega banks at their current scale? To have, my discussions are correct. They obviously need complex financial services. They need to buy and sell goods around the world, and they need to be able to finance that. But when I talk to the CFOs of these companies, I do not hear them say, I need to do it with a mega bank. What they want is actually markets that work. Markets actually work rather well when you have smaller participants who are competing with each other. And I didn't understand some of the points being made about competitive markets having higher cost structure than large, hierarchical, strange functioning banks. That's not generally the experience. So what you get, what does this mean for US capital markets? What does this mean for the availability of these essential services? Well, you finally get a market. You actually have these things provided in a market as opposed to provided with massive subsidies and strange structures today. Does this fix all your problems? No, of course it doesn't. I'm the former chief economist at the IMF. I think we live in a scary world. I think there are many problems that will come at you. And I want the Federal Reserve to have the ability to respond and to have its lender of last resort authority. But, I'll tell you what I think is going to happen here, which is very little. I think that what you'll do, not you in particular at this Fed, but the Fed system as a whole, won't do very much about this. And when the next crisis comes, and some major banks are in trouble, Citigroup, sorry to bring them up again, I hope they're in the room. Citigroup's failed 3 times in recent American history. 1982, Latin American debt. End of the 1980s, US commercial real estate. 2008 and 9 on US residential mortgages. Now, John Reed, who helped build Citigroup into its modern form, says there are no synergies. So you quote some bankers, I'm going to quote some bankers here. He says there are no synergies and it should be broken up. Sandy Weil, who lobbied really hard for the repeal of Glass-Steagall and kind of did his big deal with travelers before it was repealed, Sandy Weil also says in public and in private that Citigroup doesn't have synergies. The idea of the financial supermarket was an illusion and it should be broken up. Citigroup, when it failed in 1982, Michael may be able to correct me on this, but I think it was about 2 or 3% of US GDP. It was a big bank in the day, but nothing compared to what it became subsequently. Citigroup, when it failed, and make no mistake about it, it failed in the fall of 2008, and it was rescued by Neil and his colleagues, and I support that decision. Like this, right? But, you understand that. It was about 16% of US GDP, total balance sheet. So next time Citigroup fails, and it will fail, the historical evidence suggests, it will fail. If it's bigger or smaller than 16% of GDP, if it's 30% of GDP, if it's 40% of GDP, does that make the crisis more intense or less intense? I think it makes it worse. In any case, the key question is very, very simple. It's a matter of common sense. It's a matter of law. Can all firms in the United States fail? Does anybody have an exemption from going bankrupt? An exemption. If that exemption exists, you have a problem. You have a massive distortion of incentives. You have exactly the problems that Anat emphasized this morning. And I just don't see how you, officials, would ever be able to agree to bankruptcy or actually even apply Title II without it being incredibly messy and difficult and generating big negative consequences. I don't see how you'll do it if banks remain at or close to this scale. And I'll tell you then the biggest thing that you'll lose in the next crisis, which is the credibility and the independence of the Federal Reserve. I've sat in front of the House Financial Services Committee on a number of occasions defending the Federal Reserve against people who want to take away your independence, including on monetary policy, and they use this as a stick to beat you. I was sticking up for the Fed and defending you. The only person in the room, actually, the only person in the witness table who was doing that. I'm happy to do that again, but honestly, if the Federal Reserve allows this financial system to continue in its current form, you're putting the economy in jeopardy, you're putting the financial system in jeopardy, and you're putting yourself, the Federal Reserve System, directly in the line of political fire next time. Thank you.
Thanks, Simon. Okay, so we will do the same exercise that we did after the first panel. We've got about 17 minutes for questions before we conclude with some comments from Neil. So are there any questions? Oh, Patrick? And I'm sorry, and then would you mind introducing yourself, your name and affiliation?
Patrick Keogh, affiliated Federal Reserve Bank, University of Minnesota, Stanford. So people have said this in various ways. I think it was said in the morning, and people have called for it in a couple talks. But I was just sitting thinking of listening to Simon's talk, and I started teaching MBAs for the first time in my life at Stanford. You have to make things super simple. And if I had to make Simon's stuff super simple, I'd say, here's the analysis. These big banks lead to bad outcomes. Let's either cap them or break them up. And then you ask, well, what exactly is the source of the external effects they're causing? And are you targeting your policy directly to that source? And MBAs would say, what do you mean by external effects? I don't know what that means. So I'd say, okay, imagine I'm sitting in my backyard having a party, and some bees come and sting me. And I say, oh, those bees are coming from that garage direction. And my neighbors say, okay, I think I'll take care of that. I said, I'm going to go get some poison and try to find the nest and kill them. They said, no, you're going to be paralyzed with analysis. I'm just going to take a shotgun and start blowing your garage. And then I go in to get the poison. I come out, and my more aggressive neighbor just throws a grenade, and boom, there goes my garage. I said, it's only a little bee sting you had to fix. It would have been all set. And moreover, my garage is now gone, and the bees actually just went in that tree, so it didn't do a hell of a lot of good. So it just reminds me that whenever you do policy analysis, you got to identify the specific externality. What I didn't hear you try to do in the empirical analysis is argue how your specific proposals fix the specific externalities, so you're not just blowing up the garage and the bees just go next door anyway.
Simon, you want to respond to that one?
Yeah, absolutely. Okay, so the specific externality, as I understand it, Patrick, is that the people running these banks and the people who are funding them, I think the creditor piece is the key piece here, have the impression, understanding that there's going to be, they're more likely to get a government bailout, right? So it reduces their risks, and it encourages them to borrow more. There is, you're encouraging the view, this is what the Feldman and Stern book is very much about, that they get the upside, and the downside is not their problem. They can walk away with big bonus. That was the AIG case, as you remember, or they walk away without facing financial or other consequences. So all I'm trying to do is create an even playing field within the financial sector. Nothing more complicated than that whatsoever. And I understand that I like the garages and grenades and so on. I'm sure I'll use that in lots of contexts for my MBAs. But I don't think I'm blowing up any garages. I'm saying these big firms can't go bankrupt. I want them to be able to go bankrupt because that's what an even playing field would be about, and that's what everyone else has to do. And the higher capital requirements are a way to persuade them to figure this out for themselves.
So could I just hold on.
Unsecured creditors had to take big losses through either hybrid securities or others. Do you think that would be useless?
Oh, well, look, this is the credible commitment, Patrick. And Randall looked at you nervously as soon as you said that, right? I mean, if we're March 2008, there were plenty of the Fed could impose losses on the unsecured creditors bear, absolutely. Later in the year, Neil and his colleagues could have absolutely did think about various ways in which creditors, including unsecured creditors, could take big losses. I totally want unsecured creditors to face losses, and that will be part of a bankruptcy process, which I'm proposing. But if you just say we will impose losses, that's not a credible commitment.
So you mean if there were
current structures?
If there were hybrid securities that back out at the end and bail out everyone anyway, not activate the clause.
Did you hear the COCO discussion this morning? I know you had to step out.
I had to step out.
Okay, so Anat demolished, Anat and several of her discussants demolished COCOs.
Because it would start a run in and of itself?
For
And therefore, there would.
I guess it was
at the end of
Anat
the
and
day,
Adam
there-
Pose, and both went up to Coco's. Yes.
So I just want to add, because I think we're kind of missing, this focus on size is missing kind of two critical elements. And I like your analogy because Simon brought up the context of bailouts, right? So like New York, the city of New York needed a bailout. So the answer wasn't to break them back into 5 boroughs, right? Nobody, I think, proposed that to Gerald Ford, and I haven't heard anybody propose that yet. Secondarily, Simon brought up a great point about what happened between Goldman Sachs in the 90s and today, and it gets to Anat's point. In the 90s, they were a partnership. The economics of a partnership is extremely different than the economics of a publicly traded company. And that's a radically different question about a size cap that doesn't affect that regardless of size. And one of the big structural changes, and this goes back to a rule in the 70s from the SEC, was the ability for investment banks to go from partnerships to publicly traded companies. So we shouldn't focus on just size. You have to think more broadly to try and solve this problem.
If I might, I really love this bees analogy, and there are two things to say. First of all, I think that's right. So if you throw the grenade, in other words, if you take the wrong steps here, and we don't know, you can find that you're basically bees, which is, by analogy, I think, systemic risk, is just going someplace else. And so you haven't solved systemic risk. All you've done is just blown up the garage in the process and caused tremendous. People forget, what is going to be the pain here? I don't know the answer to that question. But how much economic pain are we going to take in this economy? And I don't see an analysis of that if we take these steps. And the other thing I would say to Simon, who has got to be one of the great speakers of all time. You know, you find some folks. I remember myself once having to follow in speaking Jesse Jackson. It was like hell. I felt like the balloon act in the circus, you know, over the corner after the tigers had come through. Great public speaker. The fact is, we just passed a law that is designed to solve too big to fail. Right? The Federal Reserve is totally behind. If you ask Ben Bernanke, Janet Yellen, the whole is a new set of provisions to solve the too big to fail problem, and it's got two legs. One is Title I, the bankruptcy, and the second is Title II. You have 2 ways to do this, and people are going through these immensely complex living wills, and presumably the government is to speak on, you know, who passed their living will and who didn't in the coming weeks. It seems to me, before we blow up the garage, to use your analysis, let's kind of see what the law we just passed, which is supported by you know, a huge percentage of the most thoughtful people in the country, actually does. Will it solve in somebody's, you know, common sense too big to fail or not?
So, Jim, you want to just introduce yourself and ask a question?
Yeah, Jim Bullard, St. Louis Fed. So the panelists expressed a sort of breathtaking support for the current situation in the wake of Dodd-Frank. So I have a question for you. Let's think of the 5 largest banks in the U.S. And you all more or less said that you think that the too big to fail problem has been solved by Dodd-Frank. That's fine. So now suppose these banks come to you with a merger proposition, and let's say B of A wants to merge with JP Morgan. Would you allow this merger on the grounds that too big to fail has been solved in the U.S.? And if not, would you not be saying that you have implicit size restrictions for which all your comments were beating up on?
One thing here. I specifically said I don't think Dodd-Frank fixed the problem. I think it made the problem worse. I think it extended the implicit Fed guarantee to many more institutions than it existed. So the incentives for the executives in most of the major banks, they're paid by options contracts. They don't have much direct skin in the game. I think if Dodd-Frank wants to deal with the situation seriously, it should think about, you know, what would the decision makers lose if they take on excessive risk? And in most of the major banks, they don't have much equity. We know about an options contract. They want to maximize variance. So the issue in terms of what does this do to the allocation of resources, what does this do to the ability of firms and individuals to prosper, I think it's really a problem going forward. And I think it dramatically increased not just systemic risk, but the misallocation of resources.
So I also want to add, I'm not sure you can solve the problem of too big to fail, right? I think that there's an inherent question. Continental Illinois in 1984, in a pre-Regal Neal world, was deemed too big to fail. Not this, sexy Citibank example, which I agree with, but a different example, right? In a financial system, because it gets back to Adam's point, we're so focused on institutions, we're not thinking about the B's. The activities and practices, what took down the system was subprime mortgages, complex instruments, SIVs, which were discussed, I think, very importantly in the first panel, that these institutions happen to be dealing with. And the best way to address financial stability is not to end lending. The most stable financial system has no lending, right? But is to look at the kind of activities and practices and then manage institutions that way. We do have size restrictions. We had a 10% deposit cap. Now, these restrictions were like Swiss cheese with thrift holding companies, and you could see kind of all these loopholes. Dodd-Frank tightened a lot of those loopholes, which I think was major progress, and kind of like Gene, I want to see play out over time. Importantly, in that 10% deposit cap, organic growth was accepted. So mergers were not allowed except this thrift holding company thing, which has how B of A got Countrywide, and we closed that. But organic growth was, right? And so the purpose of my questions, which were very micro-focused, was not to kind of answer the question of does this solve too big to fail? It's what are the ramifications of this proposal that's being put forward for a breakup? And do you think the benefits of breaking up, which will eliminate, reduce the cost of too big to fail? I don't think you'll eliminate it. Is that worth the changes in ramifications?
And I've got to say, I thought it was a very good question. I'm not sure, in fact, you could have that kind of merger for the reasons you've mentioned, but assuming that was something that was plausible, I would think at the end of the day, the Fed has to judge, and the government, as to whether or not that larger institution would be able to have a living will that was, in fact, sufficient to allow for failure. And I think we have to let the process play out. We have to take a look at these wills, use some judgment as to whether or not they work or not. But the FDIC has been in the business of resolving institutions for a long time, and if it gets to Title II.
So I'm going to reserve the last question for myself, and then I'm going to turn it over to Neil. This is for anyone who won't choose to answer it. And I'm glad, maybe segueing from what Gene just said. So I think the communication on the living will process has been clear that there are specific impediments to resolvability under the commercial bankruptcy statute, and that might require, and probably will require, not just a plan, but the firms to change things that they're doing. If those changes led to an outcome that were similar to what Simon was calling for, would you be supportive of that? So is it the question of the concern that the cap is coming first, and then we'll figure out exactly what it is, and if it was informed by that sort of process where they went through the living wills and regulators did, would you then be okay if the outcome was, if the outcome was?
Should we go down this way, or do you want to just randomly?
Anyone can answer, then once you're done, we'll turn it over to Neil.
So, I have this hand. So rather than a strict size, I'd rather it be focused on the issue. For example, if the issue is that the banks are not well governed, you have diffuse ownership, and you want to address that issue, well, one of the ways to address that issue would be to say there must, rather than go to something like a partnership, say there has to be a large shareholder who has a lot of his or her individual wealth on the line. In that type of a situation, you'd organically get much smaller banks because there wouldn't be enough people to have, say, to own 50% or to own 40% of Citibank. You would get smaller banks as an outgrowth of a policy designed to get better incentives for decision makers and improving governance.
Any other comments on that?
Well, it seems to me that I think this Title I and Title II were hotly examined, debated by the Congress, and result of a good deal of subcommittee action. It's extremely thoughtful and has been the subject of both Federal Reserve and FDIC, enormous amounts of time, staff time, examination, et cetera. It's a very rational process when you think about it. So let's sort of take it apart slowly and carefully and see whether or not, in fact, it's possible that this institution could fail in a practical way. And in a sense, it's not exactly what I've been advocating for in terms of academic rigor, but it is a rigorous process. There's no reason to think, I don't think we have to be cynical that it won't work. I think there's every reason to think that it will work. And I think before we come to judgment here, we have to see how this process plays out. It is, after all, as Simon admits, the law. And it's a law really designed to solve this problem after a huge amount of study, effort by great national institutions. And I think it holds a lot of promise.
So I guess I would say that you got to think through. There's banks, commercial, investment. They're non-bank systemically important institutions, and then there are institutions that are not prudentially regulated in our current framework who may or may not be systemically important. And if you think about the structure of Dodd-Frank, it's to bring the latter into the prudential system through designation, like the poster child AIG, and then in that designation process for both banks and non-banks, put in a series of costs relatively, hopefully equal on this scale to the regulator's best judgment of the negative externalities of their size and too big to fail questions, and then let the market balance that out between the economies of scale and size that Joseph went through. So you see things like, GE voluntarily divesting. You have activist pressure from shareholders for AIG, who I think is the poster child of this problem in the last financial crisis. And so if the marketplace sorted that out and everybody was in the prudential regulatory umbrella, and those are two big ifs, and that could be a source of where there are problems, then I'd love to see something that works better than that. But that's the ultimate goal of Dodd-Frank, and that if you can't reach that goal, then it's time to look at alternatives.
Okay, so Simon, it sounds like they're all in favor of breaking up the banks. That was very persuasive.
The longest living will, I'm told, haven't seen it, record so far is 100,000 pages. 100,000 pages. I'm not even sure what that looks like. Maybe we could get that out and take a photograph of 100,000 pages, piece of paper. I have no idea who thinks that this could actually be used as a guide to breaking up or to resolving, to bankruptcy or resolution of one of these institutions. So it's a complete charade.
So on that note, why don't we thank the panel, and we'll turn it over to Neil.
Likewise, I enjoyed.
Well, first of all, let me say thank you to everyone for this discussion. This was a much more robust and passionate discussion, frankly, than I was expecting, and I'm really pleased by that. I think some people thought, by the way, we were going to cook this. Like this was going to be a baked cake, and we were going to stack the deck with a bunch of people only offering one perspective. Hopefully, it's pretty clear we did not do that. We wanted all sides to be represented, and I'm really proud of all of the panelists for speaking out with passion and not holding any punches, and I think we all learned a lot. I certainly learned a lot because of it. Let me offer you just a few observations as I sat here just jotting down some notes. As many of you know, I'm not an economist, I'm an engineer. And to further discredit myself, I'm an engineer with an MBA. One of the things I observe is that economists are a lot like engineers, which if you put forward a plan, economists and engineers are going to work very, very hard to find the one scenario where your plan doesn't work. Okay, and I think I heard some of that today, and it's all in good spirit. That's how we learn. From Anat, I found it very persuasive that more capital is very powerful. It doesn't solve everything. You put more capital in banks and all of a sudden risk can flow to non-banks. That's true. We should pay attention to that. There is something to be said for size, and it's unclear, the trade-offs there. Again, size caps don't solve everything, so we need to study that. I found cost-benefit analysis that many people talked about and Randy spoke about persuasively very important, but I'm also sympathetic, as Randy said, no analysis paralysis. You know, all of this discussion, it forced me to step back and remind myself that we need to be humble about the environment that we live in. We live in a political environment. Think about how laws are passed. I was sitting here trying to think of one major law that was passed by all of the experts in a given field getting together, sharpening their pencil, doing years of analysis, coming up with the perfect solution, 10.724, and then that's what gets enacted. Never happened in my knowledge. Think about Dodd-Frank. Gene, with the due respect, Dodd-Frank was not the product of years of careful analysis. It was a rush to move coming right out of a crisis, and Congress acted. They did their best. Let me tell you how the TARP came about. You know, when we were negotiating the TARP on Capitol Hill, we were responding to the crisis. We went up with a plan, as many of you know, to buy assets. You know how the number $700 billion came out? It was a political negotiation where I wanted $1 trillion. Secretary Paulson said, no way, they will kill us if we ask for $1 trillion. We went back and forth, and then he picked the number 700 billion. And then I thought, okay, how do we justify 700 billion? Well, there's 11 trillion of residential mortgages. There's 3 trillion of commercial mortgages. 700 billion is 5% of that. It's a nice round number. That's how the number came up. And when we went to Congress, in the 2 weeks between when Congress acted, or when we first asked for it and when Congress passed it, financial markets were deteriorating beneath our feet. And we had to pivot from buying assets to putting in equity. That wasn't a plan. That was responding to the crisis. And so I want us all to be humble about, we should do the analysis, but we should be humble about the environment, the reality that we live in, and what a crisis is like. You know, people ask me, what was it like? We were so terrified that the financial system would collapse. The only thing that scared us more than the collapse was how in the world would we restart the economy the day after it collapsed. We didn't know how to think about that. I remember I drafted a group of people from around the government to help me set up and run the TARP. One gentleman who's at the Fed, and he's doing great. He's a good friend and a wonderful guy, 50-year-old guy. He worked 40 days straight and had a heart attack on his desk. That's what the crisis was like. And so all of these very carefully crafted, fine-tuned, sharpened, penciled proposals really don't mean very much in the middle of a crisis. We need to be directionally correct. We need to get the big things right. We need to be humble about whatever we put into place. We may have to change. I remember one of my first meetings with President Bush on energy policy. We were debating an energy plan. And there was a lot of discussion about all the potential things that could go wrong with it. And I remember President Bush said, you know, guys, time out. If this thing doesn't work, Congress will fix it. It's never going to be perfect going in. We have to do our best with the available time and with the available resources. And so I really appreciate the discussion. I learned a ton today. And this is really going to improve the process that we're undertaking here in Minneapolis. And I'm really grateful for all of our speakers and for the thoughtfulness and for all of the folks in the audience who really bring a lot of expertise and a lot of enthusiasm and energy. Thank you for doing that. Our next steps are, we've got more symposiums to come. We showed you on the back of that. Our next one is going to be May 16th. We're going to, in the next day or two, put out a save the date with more of the speakers listed. We're going to do some work to try to consolidate what we've learned here today. And we're going to keep marching forward. Again, part of the goal here is to drive a sustained national conversation about whether or not we've done enough to solve too big to fail. And more than anything, I am committed that at the end of the year, no one is going to be confused about the risks that remain. At the end of the day, it'll be up to the American people and up to Congress to decide whether or not they want to go further. That's up to them. That's their call. That's the job of our elected representatives. I feel like our job at the Minneapolis Fed is to speak up about the risks that we see so that no one has a false sense of security. And that's what I'm committed to, because I'm afraid that right now I do believe a lot of folks have a false sense of security that Dodd-Frank has solved all of these big problems that we've been talking about. And just based on the discussion here today, I hope we can agree that the problems have not yet been solved. At best, we need to see how they go. Perhaps we have to do more. So with that, thank you very much. I'm really grateful for all of your participation.